stocks, ETFs, any of those. But I'm going to use a mini here for kind of the primary example, and then we're going to show how it looks on some of the other key markets that we have going today. We have here, of course, in this case, we have the E-mini, just to get our mind set on the big picture and what it involves, and kind of the bigger picture story here. We had this kind of long 6-month uptrend going from September 1st of last year, going ahead. Then we came up with a period of time, roughly 4 or 5 months in here, were very choppy, sideways type of action, more suited to a swing trading type style. And then, of course, all of a sudden, we had a couple of weeks here of what I would call kind of a panic. Everybody kind of got really worried about several different financial issues that are going on, about debt default, a lot of other fears that are going on in the world, and so everybody kind of panicked and jumped out. And so now the question is, we're back to kind of a choppy market situation. What is next? Well, on these charts, when we add the various types of indicators on here that we can get with Vantage Point, first we're going to add, we are going to be using, we have several choices, term, medium term, long term. There's also a triple crossover type moving average that we can use, where there's 3 different averages where they all line up. For all, now this may not always be true, again, fits your time frame a little bit, but the most likely one that we're going to use is going to be the medium term crossover type of the study, because the short term tends to be a little jumpy, the long term tends to be a little slow at making the turns, and so we rely more on the medium term crossover. And we'll just throw that on the chart, talk about that a little bit as to what we have here. The most important thing that we can learn from the moving average, as I said, is the trend direction. Which way is the market going? In this case, you can see that fairly clearly here. The moving average was on the blue line that you see there. It's a 4-day exponential predicted moving average is a 4-day exponential moving average. The actual moving average that is compared is a 10-day simple moving average of the close. You have 2 different timelines here. The shorter tends to be more active, and when they go over the longer term moving average, then you have a situation where you have a signal for a change in trend. When that angle is moving up, of course, you can assume that the trend is up, and that's pretty basic moving average type of studies. When it is a crossover type of situation, then you can say that this is changing. The question that you always have, of course, is that trend starts to change. See, there are a number of times in here where we make the crossover, the predicted move of the actual moving average, and when that happens, you do see that there are some potentially some pretty good trades, and you can see it happen here. Now, the question is, at what point do you put an order? How do you get in? When and where are you going to get on board these types of things? You'll note that there are some times in periods when you'll see a situation in here where there might be a little bit of choppy type action. You don't want to be a victim of whipsaws, and so you need to know how to work with your moving average and what that moving average is telling you as to whether you want to be on board or whether you want to be on the sidelines and avoid those types of whipsaws, because that's kind of the bane of the trader quite often, and the moving average trader is the whipsaw type of the situation. So you're going to need to add something to that simple, that prediction, that crossover study here to determine more as to, kind of when do we act and when do we not act. So to do that, we're going to add another Vantage Point indicator, and that is going to be the indicators. The predicted difference, as you will see on the bottom part of your screen, is the difference between a predicted moving average and an actual moving average. In this particular case, we have a period of time going back a full year on that. And when you look at the turns, you will note that there are a couple of significant points here. You have the same type of situation that you have with the moving average when you have the crossover. You have a situation where when you can see that it lines up with the price, it kind of provides an early alert. Quite often starts to make that turn before the market actually makes a turn. It provides an early alert. So you want to keep track of that moving average as it makes that turn, and whether it is going to be, a key turn or not, and that's where your trading skills comes in terms of placing your orders. One other thing to note about this particular type of a indicator here is that it serves as pretty much a momentum indicator. Momentum being, is the trend strengthening, is it weakening? The blue line that you see here is a predicted difference, a predicted medium-term difference. The green line is a predicted long-term difference. And when you look at the difference between those two, you not only see the crossovers, but you also will note that we'll just draw a long straight line here and just kind of point out that when it gets up to a point of approximately, again, this is kind of a rough approximation, 20 points above the zero line, kind of 20 points above the norm, or 20 points below the norm, you tend to have kind of a little bounce effect, a little reversal. This is similar to what you would get with an overbought, oversold type situation where the market reaches that level, and that suggests there could be a turn. Of course, not always does that hold true, because you do have, as we had here recently with that panic situation, where all of a sudden, boom, went down through there, and we had kind of an unusual situation compared to the action over the past year or so. But the main thing about the predicted difference, you can see there are times when the market, is coming back down to that line, but the predicted difference, it bounces to that zero line, bounces off that zero line. It's the same thing as you see up here with that blue line, that predicted moving average bounces off the actual moving average to the upside. So it's a different picture, a way to portray the moving average and the moving average differences to indicate the momentum of the market, whether it is strengthening, whether it is weakening, whether it is picking up steam, or whether it's just kind of waffling to the sideways points. Now, when we have those kind of indicators, we have those on the charts, we also would be nice to have one that would show us a little bit of a shorter term indicator, and we have that with the Neuro Index on Vantage Point. The Neuro Index is that gray line that you see that goes back and forth there, kind of up and down pattern. That line indicates the difference in a predicted moving average, a 3-day simple moving average, and a actual simple day moving average. What that Neuro indicator does, it tells or suggests what the typical price will be in 2 days compared to what it is today. If that will be up, if it suggests the typical price will be higher in 2 days than it is today, you have a reading of 1. If it is lower, the reading is 0. Now, there's not an in-between here. It's either 1 or 0, so that kind of is a short-term gauge of, when to get in more of some of the other indicators coming together. Then you want to look at this from a time point, from the standpoint of having a little bit of timing help. When we put these indicators together, of course, what we have is, good clues. We have too much information here, too many days of information here, so we're going to cut this all the way back down to just a 2-month chart, and then we're going to back it up a little bit so that we can see a little bit more about where the market might be going and where it might be heading. We're going to back it up all the way in here to about April to kind of get a clue of what we can see, what it's going to be telling us. When we move back to April, first we're going to look at some of the crossover situations and